So the final account is just like trading profit or loss account. But what we do for final accounts is that it is going to be for publication. It's going to be for external use. But the trading profit or loss that we have been preparing at the JHS level, at the university level, for sole proprietor or for a company, that one is for internal use. So what we do is that we bring our revenue, we bring our uh, sales returns or the return inwards, we subtract, we bring purchases, we bring the opening stock, we have our cost of goods available for sale, or if we have carriage inwards, return outwards, we subtract. You see, that's what we do at a basic level. But that particular account is for internal use, so you can show everything. But for final accounts, this one is going to be for publication, external use. So what we do is that we bring some major items. Instead of we bringing sales, return inwards, we now do workings for the net sales. So you do workings for the revenue. Then you bring your revenue, then you bring your return inwards. Anything again, you subtract it. If you want to show your cost of sales, we show the cost of sales directly. How do we determine the cost of sales? It's the same thing. Your opening stock, purchases, add your carriage inwards, less your closing stock, and all those things. We find our purchases. Then we don't bring salaries and those things. No, we put all of them together and have administrative what? Cost. So all the rents, salaries, and wages, all those things will be put together to have what we call administrative cost. Then we bring the administrative cost to only the accounts, which is the statement of profit or loss or the income statement. We don't bring advertising, commission, discount allowed, and those ones. We put all of them together and have a selling and distribution what? Expenses. So we measure them, like we group them and bring them to the final accounts. So whoever wants to know how the cost of sales is determined, the person will go to the notes. So we do workings. We have note to the account. So if you come to your bank interest, your interest on loan and all those things, we don't bring them one by one. We now bring them as a finance cost. So you put all your interest on bank overdrafts, interest on loan, interest on issue of preference shares, all those things will now be put together to have a finance cost, which will bring only one figure for finance cost. So whoever wants to know how the finance cost is being determined, the person will refer to the notes that we attach to the accounts. Okay, so that is how we go about the final account. It's the same thing as the account that you are preparing, but just that we bring only major items. And one of these major items is the revenue. We do workings for the revenue. And this particular revenue is always affected by IFRS 15, revenue from contract with customers. Then we count to, instead of you bringing purchases, opening stock, and those things, we don't bring it. We do workings for it. Then we have our cost of sales. The cost of sales will be affected by IAS 16, which is PPE, because we charge the depreciation to cost of sales. The cost of sales might also be affected by IAS 2 inventories. So we do adjustment for the cost of sales. Then we come to administrative expenses. The administrative expenses can be affected by IAS 37 provisions. It can also be affected by any other standards. So we put all our costs together and have the administrative expenses, the salaries, all those costs that are incurred administratively, that are incurred to run day-to-day or to carry the day-to-day operations of the company will be put together as administrative costs. Okay, then we come to selling and distribution costs. The advertising, the commission, discounts allowed, all of those ones will be put together to have selling and administrative costs. Then we have finance costs. Finance costs relate to all the interest that the company will be paying. Then we can have other income or investment income, other income, any other thing. So we don't show it like the way we have been showing it. Sales less return inwards, cost of sales. Then you have opening stock plus purchases. No, we don't do that. We bring only major items. The first one is revenue, cost of sales. Then you have your gross profit. You bring your administrative expenses, which is the salary and those things. Then you bring your selling and distribution, which is expenses relating to selling and distribution. Then you bring your finance cost. Then you have your net profit, or you add your other income, any other issues. Then you bring your income tax, which you are going to do working for IAS 12. Then we bring it, then we move on. If you go to statement of financial position, which is a balance sheet, we don't do this one that we have been doing again, that we say we have the fixed asset or the non-current asset, then we put cost, we put accumulated depreciation, then we put carrying value. No, we do workings for that one and bring only the carrying value. We bring only the carrying value. So that the non-current assets will be grouped. We have the intangibles, we have the PPE. So we don't show plants, we don't show building. We put all of them together and have PPE. So if you have plants, fixtures, and fittings, you can put all of them together and have PPE. But mostly the building, the land, the plant, and equipment, we put all of them together and have PPE. And this will be shown on their carrying value. So you do workings and get your carrying value. Okay, then we move on to intangibles. If you have any intangibles there, you bring it. Then we come to the current assets. It's the same thing. The presentation for current assets is the same thing. But what we do is that for the statement of financial position, we do total assets is equal to total equity plus liabilities. So it is prepared based on the accounting information. Total asset is equal to total liabilities plus equity. So you count your equity, you show your equity items, shareholders' capital, retained earnings, revaluation surplus. You show all those things. Then if you count your liabilities, you show the non-current liability and the current liability. Basically, that is what we do about the final accounts. All right. So you are familiar with it. You don't have any issue with that. Okay. For this particular topic, it can be a final account or it can be a cash flow. But I can tell you that you will not meet cash flow in the exam. All right. But the cash flow is the same as what you have done at the degree level or at the SHS level. Okay. For the final accounts, you will be preparing or you will be asked to prepare the following statements. The first one is statement of profit or loss and other comprehensive income, or statement of changes in equity and statement of financial position. Before you can prepare this account, you have to show notes. You have to prepare notes or you have to do workings. The workings are the notes. All right. Then the question can be given to you in so many ways. They can give you a raw trial balance and now ask you to prepare a statement of profit or loss, a statement of changes in equity, and statement of financial position. Another one is they can prepare the statements, but certain information will not be taken into consideration. Then they will now give you those information now so that you can adjust or you can redraft the financial statement being prepared. So they will prepare the financial statement, all right, but preparing the financial statement, certain issues were not taken into consideration. Certain issues were not taken into consideration. So the question can now ask you to now prepare a revised financial statement. And that is the first question that we are going to look at. Okay, so let's look at the question one. Question one. Can someone read the question one for us?
The draft statement of TAFO Limited for the year ended 30th September 2008 have been prepared by the accounting officer of the company as follows. Draft statement of comprehensive income for the year ended 30th September 2008 and draft statements for financial position as at 30th September 2008. The company, however, has not incorporated all relevant financial information pertaining to the year ended 30th September 2008 in the draft financial statement. The following may be relevant. A. Included in property, plant, and equipment is a production machinery acquired in October 2005 at the cost of 3.25 million. The estimated useful life of the machine is 10 years. In 2016. So should I read all the...
Yes, please. The footnote is very important.
Okay. In 2016, environmental protection laws in the locality that TAFO Limited operates tightened, limiting the amount of production companies could do, especially at certain times in the day. Accordingly, an impairment review was carried out on 30th September 2006. The fair value less cost to sell and the fair value in use were estimated at 2.34 million and 2.47 million respectively. The outcome of the impairment review was accounted for correctly in the financial statements for the year ended 30th September 2006 in accordance with IAS 36 impairment of assets. Subsequent to the impairment review, the industry of Tafo Limited has in recent time experienced a relaxation in the tight environmental laws imposed in 2006. Amount of production from production machines has increased. Consequently, an impairment review has been carried out by management of Tafo Limited on 30th September 2008 on the production machinery again. The fair value less cost to sell and the fair value in use estimated at this date are 1.8 million and 2.08 million respectively. Property, plant, and equipment are recorded at the carrying amount at 30th September 2008. That is after depreciation for the year, but before the effect of impairment review undertaken on 30th September 2008.
So,
B.
Auntie Gina,
Oh,
okay.
yes, please.
After reading that footnote, how do you feel?
It involves a lot of requirement too.
Yeah, so the final account is purely standards. That's what I want
Yeah,
to say. If you don't know the standards, if you're not on
and
top of
that
the
you cannot
standards,
do.
you
Yeah,
cannot do anything. And the standards for the final accounts is easy to adjust than the standard on its own. You'll be given a standard question on its own, but you also be given standards for the final account. But adjust the one for the final account is always easy because it will not be into details. All right. So what you do is that before you even try to tackle this question, read the requirements. Let's read the requirements first.
required. Prepare the revised statement of comprehensive income for the year ended 30th September 2008 and the revised statement of financial position as at that date using relevant IFRS standards.
Okay. So you can see that they have already prepared the statement of profit or loss and statement of financial position, but they haven't taken into consideration the following what?
Adjustments.
Yes. So what we do now is that we are going to prepare a revised or a new statement of profit or loss and a new statement of financial position, taking into consideration these particular footnotes. So what you do now is that you are going to use the same items over here, but you are going to prepare a revised one. The revenue will still be the same. You are going to use the revenue. So if any item over there is going to affect revenue, then you adjust the revenue. Then you count to cost of sales, you count to administrative expenses, you count to distributive costs. Then profit before tax. If you do your calculations well, you get that. Your tax expense. What is the new tax expense now? You use the new one. Then you have your profit for the year. Then the property, plant, and equipment. This is the one after adjusting everything for the year. But there are certain issues that we are not taking into consideration. So what will be the effect of that particular one on this particular item? Then you adjust it. The current asset, is there going to be anything that is going to affect it? You take them like that. Okay. Another one that I want to show you, you can decide to do workings or you can add it like the way we add the console. You see the console, we put everything in bracket and add, isn't it? You can decide to do it like that for the final account. But some of the final account adjustments is going to be plenty. And if you can't have a space to add, so the advice is that you should be able to do adjustment for them. So what we do is that we are going to prepare or we are going to put a raw statement there. Then we do adjustment and send the figures there. You don't have to read all the footnote before you start. Some of the items, you are going to pick them like that. No adjustments will be done to them, especially distribution costs. Mostly, there will not be any adjustment for it. Sometimes to revenue, there might not be any adjustment for the revenue. There might not be any adjustment for the revenue. So you can put your raw statement there like that. You can put your raw statement there like that. Then before you start getting the figures. So we put a raw statement there before we start tackling the footnotes one by one. Okay. So what's the name of the company? Okay.
Tafo Limited.
Tafo Limited. Okay. So we have revised what? Revised statements. Statement of profit or loss. Okay. Revised statement of comprehensive income. Okay. What they say is what we are going to do. You are using time. Comprehensive income for the year for the year ended what?
30th September 2008.
Okay, 30th September 2008. Okay, so you can put your currency sign there. Okay, so they are keeping 3 zeros, so you put the 3 zeros at the top. Then you count your revenue. Okay, you can scan through the additional information and see whether there will be anything affecting the revenue. Can you see any item affecting the revenue? I can't see anything. So I can bring all the revenue figure there. The revenue figure is what? 245,163. Or someone can decide to put the revenue figure into brackets like this. If there's any adjustment, then you adjust it. Okay, let's count to cost of sales. Cost of sales. Okay, cost of sales, mostly we do workings for it because it will be involving a lot of issues. So we can do workings for that. All right. Then after that, you have your gross profit. Don't do anything. Don't bring the gross profit. If you subtract your cost of sales from the revenue, you get your gross profit. Then you can put your administrative expenses. Administrative expenses. Then you count your distribution cost. The distribution cost. Then you count your finance cost. Okay. Though finance cost is not in the question, but you can put it there. If there's nothing over there, then you put dash. Okay. Then we have our profit before tax.
So what if there are other income that you need to add?
If there's any other income, okay, you can decide to net it against some of the expenses. There will not be any issue about that. So if there's other income and the income is somehow related to finance, is an interest income, you can decide to net it against the finance cost. Okay, but
Yes,
you
sir.
have to show the other income. But this one, I'm not sure there's any other income here. Okay, so you can also put the other income there. If there's no other income, then you put that there. Okay, so profit before tax. Then you now bring your tax expense. Okay, then you have profit after tax. Profit after tax. So if there's any revaluation issue, then you bring other comprehensive income. And I'm not sure there is any revaluation yet. So after this, you can now move on to TAFO Group, TAFO Limited, not group. Revised statement of what? Statement of financial position. Statement of financial position as at is the same day.
Yes, please.
30 September 2008. Okay. Then you can put your this thing here. Then you can put, because you are going to have current assets. So the first one is you have non-current assets. Another non-current assets, what do we have? We have PPE, isn't it?
Yes, sir.
Okay. So you can bring the
Yes.
PPE. You can write PPE.
You can write
Nobody's
PP.
going to
Nobody's going to
see anything.
see anything.
Okay. So you can write a PPE. It is allowed. Okay, PPE. Then you count to, what is the next one? Current assets.
Yes, sir.
Okay. So another current assets, you can put the ones that you have there. Okay. We have inventory. We have trade what? Trade receivables. We have bank. Then you leave it. You count to equity and liabilities. We don't show working capital over here. Under IS1, presentation of what? Financial statements. We don't do the one that you have been doing, net asset. No, we show total assets and what? Total liabilities. Total asset is equal to equity plus liabilities. That is what we show. So the equity, you have your stated capital, which will always be the same, but you can leave it open and read the footnotes. If there's any If there's nothing that is going to happen to it, you can bring it like that. Let's come to retained earnings. Retained earnings. Then you have 5 years. 5 years, what? 11% preference shares. Preference shares. Okay. Then you now go to your, we don't have, okay. So you have current liabilities there, but since you don't know what is going to happen, you can leave a space for non-current liabilities before you count your current liabilities. So we have the current liabilities. Since you are now going to take some of the footnotes, so we have trade and other receivables. Trade and other payables rather, not receivables. Okay, that one, so you can leave it. Then we have current tax. The current tax will always be the current year estimate, the one that we did under IS 12. Okay, then you have your, then let's take the footnotes one by one now. So we can now move on to workings. Then we have the workings one. Okay, so let's retake that particular A.
Okay. So included in the property, plant and equipment is a production machinery acquired in October 2005 at the cost of 3.25 million. The estimated useful life of this machine is 10 years. In 2006, environmental protection laws in the locality that Tafol Limited operates tightened, limiting the amount of production companies could do, especially at certain times in a day. Accordingly, an impairment review was carried out on 30th September 2006. The fair value less cost to sell and the fair value in use were estimated at 2.34 million and 2.47 million respectively. The outcome of the impairment review was accounted for correctly in the statements in the financial statements for the year ended 30th September 2006 in accordance with IAS 36, impairment of assets. Subsequently to the impairment review, the industry of Tafol Limited has in recent time experienced a relaxation in the tight environmental laws imposed in 2006. Amount of production from production machines has increased. Consequently, an impairment review has been carried out by management of Tafol Limited on 30th September 2008 on the production machinery again. The fair value less cost to sell and the fair value in use estimated at this date are 1.82 million and 2.08 million respectively. Property, plant, and equipment are recorded at their carrying amounts at 30th September 2008. That is after depreciation for the year, but before the effect of impairment review undertaken on 30th September 2008.
Okay, this question is about IS 36, isn't it?
Yes, please.
Okay, so they are basically talking about review or reverse of impairment loss. So we say that when the conditions that are causing the impairment are no longer there, it is the company has to reverse the impairment. But the impairment should not be reversed. The amount should reverse should not be more than the impairment loss what recognized. The amount to be reversed should not be more than the impairment loss what recognized. Or if you want to review the impairment loss or you want to reverse the impairment loss, you should assume that the impairment has not happened at all. The impairment has not happened at all. The impairment has not happened at all. We only do this when the amount of the gain, when the increase in the value now after the subsequent impairment or after the subsequent review is now more than what? the first impairment. So we assume that the impairment has not happened at all. Okay, let's now look at this question. What was the first impairment? When was the asset purchased? When was the asset purchased?
October 2005.
So acquisition date is October 2005. Okay, October 2005. October 2005. Okay. What is the useful life of the assets?
10 years.
10 years. Okay. When was the first impairment done?
30th September 2006.
Okay, that is a year after acquisition, isn't it?
Yes, sir.
Okay. So for us to calculate impairment, we need to get the recoverable amount and also the carrying value at the date of what the impairment. So let's determine the carrying value of this property at the date of the impairment, which is the 30th September 2006. Okay, what is the value of the asset? What is the cost of the asset?
3.25 million.
3.25 million. So it will be the cost minus what? The depreciation. The depreciation will be for only 1 year. Is that correct?
Yes, sir.
The question you didn't say 1st October, but since they say in October, you assume that it was bought on 1st October. So that will be a full year depreciation. So the depreciation carrying value will be the cost minus what? 3.25 divided by 10. Am I correct with that?
Yes, sir.
Okay. So what will be the carrying value? It will be 3.25 minus the depreciation is what?
0.325.
0.325. So what will be the carrying value?
2.925.
2.925. Okay. This is the carrying value. But the question is, at this date, what is the recoverable amount of the property? What is the recoverable amount of the property?
$2.47.
2.47. We pick the highest one. So you can see that you are giving the fair value less cost to sell and value in use. So we pick the highest one. So our impairment loss will be 2.47 minus 2.925. So what will be the impairment loss?
0.5.
Okay, 0.455. Okay. So they say that this has been accounted for correctly, isn't it?
Yes.
Okay.
Yes.
All right. So let's move on. We are only interested in the subsequent issues. Okay. Let's come here. So this particular asset will be depreciated. The new value of the asset will now be the recoverable amount. So from October 2006, the new value of the asset, will now be the recoverable amount, which is 2.47. Okay, so this will now be depreciated over the remaining useful life of 9 years. Let's come. When was the new, or what date was the impairment review, the subsequent impairment review? When was it done?
30th September 2008.
30th September 2008, which is what? The reporting period or the reporting date for this particular year. So from 2006, 2007, that will be 1 year, isn't it?
Yeah.
Okay, 2007 to 8, that will be what? 2 years. So after the
Yes.
first impairment, we have done the second impairment after 2 years, isn't it?
Mhm.
All right. So after the 2 years, we need to find the carrying value of the asset on 30th September. On 30th September 208. The carrying value will be the same as 2.47 minus 2.47 divided by 9 years times 2. Do you agree with that?
Yes.
Okay. And that will give us what? What will be the carrying value? 2.47 minus what?
Zero 0.49. 0.549.
Let's make it 0.55.
Okay.
Okay. The question says that they have accounted for the depreciation already, isn't it? But they haven't taken the impairment loss into consideration. So the depreciation of 2.47 divided by 9, which is a year, they have done the depreciation already. They have done it. They have taken it into consideration before preparing the draft financial statement. But they haven't considered the impairment. So if you look at the last paragraph over there, they say that property, plant, and equipment are recorded at their carrying amount at 30th September. That is after depreciation for the year, but before the effect of impairment review undertaking on what? 30th September. So we are only going to take into consideration the impairment review. So what will be the carrying value now?
1.292.
1.92 million. Okay, what is the recoverable amount at that date?
2.08.
2.08.
2.08.
08.
Okay, 2.08. So the recoverable amount is 2.08. What is the increase? What will be the gain? It will be 2.08 minus what? 1.92. What is the increase in the value?
0.16.
0.1 what?
6.
6.
Okay. So that is now the what? That is the amount that we are going to what? But the impairment was what? 4.455, isn't it?
Yes.
Okay. You can see the increase is still below what? 0.455, isn't it? All right.
Yeah.
So what we do is that we are going to reverse what? 0.16 out of this one. So what we do is that it means that the value of the asset should be 2.08, but it is in the books at what? 1.92. So what do? We now go and add 0.16 to PPE. Or since they are keeping 3 zeros, we multiply this by 1,000. So 0.16 times 1,000. Okay, that will give us 160.
Mhm.
Is it 160?
Yes.
0.16 times 1,000. Okay, they are keeping 3 zeros there. So we are going to reverse 160 and add 160 to the PPE. Okay, because in the PPE is 1.92, but at the reporting date, the value has now increased to 2.08. So what do? We need to go and add the difference to the PPE and reverse this one of the impairment. The impairment that was taken to profit or loss was 0.455. So now the value has increased by 0.16. This is still below the impairment loss. But if the gain, the increase in value should be maybe 0.6, you can see that 0.6 is higher than what? The 0.455, isn't it? All right. So if the impairment gain, the increase in value is higher than the previous impairment, we assume that the impairment has not happened at all. The impairment has not happened at all. If the impairment has not happened at all, what will be the carrying value of the asset as at this date? That is how we adjust it. But if the increase is below the impairment that was recognized, we add all of that one to the PP. We reverse all of that amount, but because that is still below what? the impairment that was recognized. So we add all the 0.16 to PP and reverse that portion of the impairment. So the entry will now be, let's go to the PP. What is the value of the PP in the statement of financial position?
60,424,000.
Okay, 6424. Then we now add 160 to it, isn't it? Then we go to
Yes,
profit
please.
or loss. We go to profit or loss. How do we reverse the impairment? The impairment was charged to administrative expenses. So what we do is that we now take our administrative expenses. Okay, let me just do the workings for that. So let me show the administrative expenses. So let's have workings 2. Admin expenses. What is the figure there? So the figure per,
73,549.
okay, the figure per the statement is
73,549.
549. Then we come to reversal of impairment loss. Reversal of impairment loss. Reversal of impairments. So this one, is it going to be addition or subtraction? The 160, is it going to be addition or subtraction?
Subtract.
Addition or subtraction? My people, is it going to be addition or subtraction?
Subtraction.
It will be a subtraction because this is a gain against what? So this will be
Yes.
160. I mean, is it? Osina? Yeah, regular. Yeah. I did them, but I can't it's like one inside. Okay. ABFR. Okay. All right. I may be the same thing now. Okay. All right. Okay. All right. Okay, seniors, sorry for that. All right. So, okay. So we are done with the footnote 1. This is what they're asking you to do. Okay. And this is about impairment. If you don't have a deep knowledge about impairments, it will over you. All right. Let's look at the second one.
B. On 1st September 2008, Tafel Limited purchased materials used for production of its product at 0.78 million USD under a 90-day credit terms. The exchange rate of 1 USD in cedis at the purchase date was 6. At 30th September 2008, the exchange rate of 1 USD in Ghana cedis is estimated at 6.15 cedis. The purchase is included in cost of sales and trade payables at their transaction values in cedi terms at 1st September 2008.
Okay. So what standard is that?
IAS 21.
Is what?
21 exchange rate.
Yes. So you can imagine. Senior Sebastian, you can imagine. You don't know the standard, you don't know. Yes. So
I'm just observing it.
yes, the final accounts, unless you want to do magic. All right. Final account is full of standards. So this is IAS 21, and you are happy that we have done 21 yesterday. So I hope we can go about this question, isn't it?
Sorry, Donna, I want to ask a question.
Yeah.
Please, this question, is it for corporate, like, is it corporate or is FR?
This is FR. We don't have final accounting corporate reporting.
Hey, and in detail like this.
Or you are even afraid. Whatever is happening here, pay attention on, because
Okay.
you can go to the exam hall and you see a similar question. So whatever is happening here, if you don't understand, ask question. This is the last time that you're going to ask question. Okay. So on 1st September 2008, so we bought this on 1st September. After 30 days or 29 days, then we are preparing our financial statements. Okay. So the thing
Yes,
is, so let's count the workings 2. This is workings 2. Okay. So let's count to the workings 3. Okay. So at the time of the purchase, how would this material be what recorded? The time that we are purchasing it, which is the 1st September, the September 1, 2008. What we are going to do is that the company will recognize this as at the spot rate, isn't it?
yes, sir.
Okay. So we are buying this in what? In US dollar. And how much?
Yes,
How
sir.
much is the US dollar that we are buying? How much is it?
0.8 million.
0.78 or 0.
0.78.
Okay. We are buying on credit, isn't it?
Yes, sir.
Okay. The exchange rate
please.
is how much?
6 cities as at then.
6 cities. Okay. This place, are we going to multiply or we divide?
We are going to multiply.
We are going to multiply. So what we do is that we are going to debit purchases, which will be 6 times what? 0.78. How much are we getting?
4.68.
4.68. Okay. Then we credit what? Payables. Am I correct?
Yes, please.
Okay. This is at the time that we are doing this. This will also be 4.68. Okay. But the issue now is this is 1st September. At 30th September. At 30th September. At 30th September 2008. Have we cleared our debts?
No.
Okay.
No.
So the question now is, whatever is going to happen, we are still going to pay the people 0.78 US dollars, isn't it? Okay.
Yes.
But we are going to use Ghana cedis to settle that amount. So you ask yourself, if you should pay the people at a reporting date, what will be the CD equivalent that you are going to use to pay? So let's look at the CD equivalent. Let's look at the CD equivalent at the reporting date. What will be the CD equivalent if we want to settle?
6.15.
Okay, that will be, okay, how do we get that?
4.79. It's
Hey.
0.78 times 6.15.
Okay, 0.78 US dollar times what? The exchange rate at that date,
Yes.
which is 6.15. How much are we getting?
4.797.
4.797.
7.
Can we make it
Yes, sir.
4.8?
Okay.
Okay. Okay. First, if you should pay on 1st September, the day that you bought the thing, you are going to use CCDs to pay $1, isn't it?
Yeah.
Okay. But you haven't paid. And at reporting, if you should pay the people at reporting, you are now using 6 cities, 15 pesos to pay them. It means that you are going to incur additional cost of what? 15 pesos, isn't it?
Yeah.
So you can see that the amount that you are owing the people is 4.68 at the date of the transaction. But if you want to pay them today, it is what? 4.80. What is happening?
It's an increase of 0.12.
And that will give us exchange what? Loss. So the exchange difference loss will be 4.80 minus 4.68. Or, okay, the difference will be, yeah.
Linus.
Yes.
Please, so I just joined. Please, I want the question number. Please.
Question number 1.
Okay, thank you.
All right. So what is the difference?
0.12.
0.12. Okay. Do you know that someone can also calculate the loss like this? The exchange loss. Someone can also calculate it like 0.15 times 0.78. Is that correct?
Yes.
Can you also see it like that? because we are going to incur additional
Yeah,
15 pesos.
Yeah.
Yeah. So that will be 0.12 million. So this is an expense, isn't it? Okay.
Yes, sir.
This is an expense. This is a loss. So what we do is that this will now this will be added to administrative expenses. So you add it to administrative expenses. The question didn't say how we should go about it. So you add it to administrative expenses. Exchange rate loss. And that will be 120. Okay, we are adding. So this will be 120. This is a cost. It will be added. But if you go to the statement of financial position, the payables are shown as how much?
7,806.
No, that is the total payables. But the one relating to the foreign payables, it will be shown as how much in the payables?
And to be shown as 4.68.
Yes, the question says that was the thing. They have done the entry for only the what? The date of purchase. It means that the 0.12 is not included. So you go to your
Yes.
payables and now add.
Add it.
Okay. So you have your payables there. What is the amount of the payables? It is 7,862. Then you add a 120 to it. Because we have 4. It is still carried at the 4.68, which is the value at acquisition, which is the date of purchase. They are still using the 4.68. But this has increased. The CD equivalent has increased. So the CD that you are putting over there is increasing. The CD that you should have put there relating to this particular debt is increasing. So go and increase it too. That is about that one. That is about that particular question there. Let's come to the C.
C. The 5 years, 11% preference shares presented on the statement of financial position was issued at the beginning of the current year and are recognized at par of 30 million. The company incurred issue cost of 0.8% at the par value, and the preference shares is redeemable at a premium of 5% over the par value. The effective interest rate of the preference shares is 12%. Issue costs paid is included in administrative expenses.
Which standard is this?
IFRS 9.
Okay. So preference shares are treated as a debt instrument, isn't it?
Yes.
So this is a financial liability that will be classified not to profit or loss. So we are going to use this one to amortize costs, isn't it? All right. So if you are going to classify the financial liability through amortized cost, issue cost, what do we do to the issue cost? What do we do to the
You capitalize it.
Okay,
Capitalize
issue
it.
cost should be capitalized. So, but what
Yes.
did they do? They have added the issue cost to administrative expenses. So we have to go and remove it. So the issue cost, we find that and remove. And that will be 0.008. Am I correct? Times 13,000. It is done 0.8 at par value. So the par value is the 13 million. So that will be
Yes, sir.
0.8 divided by 100. That will be 0.008 times 13,000. I'm getting
Yes.
104.
Yes.
Okay. Are we going to,
0.104.
okay. Are we subtracting or we are adding? The issue cost was
We are
added.
subtracting.
So we subtract. Then we now
We are
come and
subtracting.
show how we should account for what? The instruments. So let's come to workings for the financial instruments. So the financial instrument will be shown at what? Fair value. How do we determine the fair value? Okay. The fair value will be determined as the purchase price, which is 13,000. We are keeping 3 zeros. Then the issue cost will be capitalized. So issue cost of what? 104, isn't it? Issue cost of 104. So what will be the net? What will be the fair value now? I'm getting 12 896. Is that correct?
Yes, please.
Okay. So we have 12,896. Then we now pay interest, finance costs. The interest will now be paid charging using the what? The effective interest rate. What is the effective interest rate?
12%.
So that will be 1.12 times 12,896. What will be the finance cost?
154.7.52.
Okay, can you run it to the nearest one?
So 1548.
Okay, 1548. But what would they do? They will now pay what? A coupon. Is that correct?
Yeah,
And the coupon will be what? 11%. So
11%.
the interest that they are paying is what? 0.1 times what? 13,000. That will give us how much?
So 1430.
Okay. Okay. Let me tell you something. You see, the actual interest that should have been paid in relation to the preference shares is 1430. 1430. That is the actual interest that you should be paying every year. So every year you pay interest of 1430. And you give that 1430 to the people. But what is the interest that we are getting here? It is 1548, isn't it? The interest is 1548. What is the difference? The difference between the coupon and then the finance cost. What is the difference?
118.
1 what?
8.
Okay. The 118 relate to the issue cost. Relate to the issue cost. Okay. Okay. So if you subtract, what are we getting?
So if we subtract what? The coupon from the
Yeah, it will be this plus this minus the coupon.
1301.
13014.
Okay. 13
014.
13014.
14.
Okay. So this should be the closing balance. This should be the balance carried down on the what? On the instrument account. So this should be the value in the statement of financial position. This should be the value in the statement of financial position. So let's now go to the statement of financial position. What is the value that we are getting? What is the value of the bond there?
13 million.
Okay, which is 13,000. That is the figure that they are showing.
13,000. Yeah.
Okay, so you can decide to come and add the 10 something to it, or you can just bring the 1314 here, or you can decide to put a 13,000 plus the 14. Okay, so that is how you are going to show it. Okay, the finance cost will go to where? Will go to profit or loss.
Yeah,
So we
yeah.
now have a finance cost of what? 1548. Are we okay? All right. Let's move on to the next one. So that is all about that. That is a financial instrument.
D. Tafo Limited has a 1-year contract with one of its institutional customers, which started in June 2008. Tafo Limited, in accordance with the contract, supplies the customer a fixed quantity of its product of 300 units every month at a fixed price of 200 cedis per unit. Tafo Limited, since 2008, has been supplying the fixed quantity of its products as per the contract. However, the price of materials imported required to manufacture the company's products has increased due to the shortage in materials as a result of the adverse impact of the COVID-19 pandemic and the continued depreciation of the Ghana cedis against the US dollar. The current material cost per unit is estimated at 210 per unit, and the conversion cost is also estimated at 5 cedis per unit. Management in planning of discounting discontinuing the supply of goods to the customer for the remaining 8 months of the contract. The contract provides a party to give the counterparty at least 2 months notice in terminating the contract. The penalty for terminating the contract is 8.5% of the sales or purchases value of the remaining units to be supplied or bought. The only entry made in respect of the contract is revenue and product cost for the first first 4 months of the contract included in the revenue and cost of sales figure respectively in the draft account. What should be
Which
revenue?
standard is this?
Anything like this
Revenue.
one.
Which standard is this one?
It's
Um,
revenue.
No,
revenue.
please.
Hey.
I'll solve this question under IS 37. These provisions. So this is what we call onerous contracts. Auntie Gina, have you remember something like that? Onerous
No,
contracts.
yeah, you said it, but I forgot.
No, we even solved this question under that. I intentionally brought this question there. Okay, this is what we call onerous contracts. So onerous contract is a type of contract where the benefit that you are going to get is lower than the cost that you are going to incur to what? To fulfill the contract. Okay. Let's look at the selling price. What is the selling price for this particular contract? Yes. Yes, Sinakojo. Your hand is up.
Also, please, with the earlier workings, the issue cost, is it 10.4 or 104?
No, it's 0.8 times the 30 million. So we are keeping 3 zeros. So do it
But
again.
you get it will be 10.4.
Are you sure? It's 0.8
0.8
divided by 100.
0.8
Divided by 100 will give you
0.8%.
0.008. No, the company
It is
incur issue
0.08%.
cost of 0.8%.
Oh, okay.
0.8%. That will give you 0.008 times 13,000. I'm getting 104. Can someone
Okay,
confirm
thank
that? All right.
It's correct. It's correct.
Okay. So this is what we call onerous contracts. You see, onerous contract is that type of contract that the cost that you are going to incur to fulfill the contract, or the additional cost that you are going to incur to fulfill the contract, is higher than the benefit that you are going to get. The cost to fulfill the contract is higher than the benefit. So what we do is that we decide to terminate the contract. If you want to terminate the contract, the standard says that you should make provision for what? The lower of the additional cost, or the what? The penalty. The lower of the additional cost or the penalty. So this is what we call onerous contracts. You can see that the selling price is a fixed price of 200 cedis per unit. But this has been like that for what? 4 months. But if the company want to fulfill the contract for the remaining 8 months, the raw materials, the cost of the raw materials is now 210. And the conversion cost can be the variable cost, the labor cost. It is now 5. It means that for you to fulfill the contract for the remaining 8 months, you are going to incur additional cost of 15 Ghana cedis to the selling price. You are going to sell this particular item for 200 cedis per unit, but the cost that you are incurring, the production cost, is 215. It means that you are going to make a loss of what? 15 cedis. So if you are going to make a loss of 15 cedis, the question now is, should I terminate the contract, or I should go ahead to what? To incur or to provide the unit for the remaining what? Contract life. The standard says that make a provision for the lower of what? The cost or the penalty, because you have a commitment, you have an obligation to incur that particular cost in the future. So you are going to incur additional 15 cedis to buy this item. So there's an obligation, there's a future obligation. If you want to terminate it, you are going to pay the people. So you have an obligation to pay for the penalties. So make provision for the lower of any of the two. So the provision should be on the additional cost that you are going to incur. What is the additional cost? The additional cost is the 15 cedis, because
Yes,
whatever we are going to sell is 200 cedis.
Mhm.
But we are incurring a cost of 215 to fulfill that. So we are going to incur additional cost of what? 15 cedis. So let's look at the cost that we are going to incur. So let's look at workings 5, onerous contracts. Hey, I don't know how to write the onerous. Okay. Okay, onerous contracts. So make provision for the lower of the cost or that. So the additional cost. Let's look at the additional cost. Okay, the additional cost is 15 cedis per unit, isn't it? The additional cost of fulfilling the contract, will it be 15 cedis per unit?
Yes, please.
How many units are we producing every month?
300,000.
3,000.
And how many
3,000.
months is left? It's 3,000 every month. How many months is left?
8 months.
Okay, so what will be the total cost that we are going to incur? So 15 times 3,000 times 8. The contract is 1 year. The contract is 1 year, and the contract is 1 year, and we have supplied the goods for 4 months already. It means I left with what? 8 months. So the total cost is what? 360 Ghana cedis.
Mhm.
Is that correct? Okay.
Yes, sir.
Yes,
Let's come
please.
to the termination cost. If we want to continue fulfilling the contract, this is the amount that we are going to incur. But what if we want to terminate the contract? What are the agreement says about the termination?
You say that the penalty for terminating the contract is 8.5% on the, is it that side?
Yes. The penalty for
Yes.
terminating the contract is 8.5% of the sales or purchases value of the remaining unit to be supplied or bought.
Mhm.
Okay. So the question now is, if we want to purchase, it will be 215, isn't it?
Mhm.
But if you want to sell, it will still be 200 cedis. If it should be you,
Yes.
on what amount are you going to pay the penalty on? You are giving me 200 cedis. The highest amount that I can get from you is 200 cedis. So if I want to pay you, I'll pay the penalty on the amount that I'm getting from you. You are going to pay me 200 cedis per unit, but I'm going to incur a cost of 215. No, I cannot pay 215. I cannot pay the penalty on the 215 because you are not going to give me the additional 15 cedis. So the termination cost will be charged on the sales value. It will be charged on the sales value. So how do we get a sales value? The sales value is 200 per unit, and we are producing 3,000 units, and it's left with what? 8 months. So the termination will be calculated as the 0.085 times 200 times 3,000 times 8. Okay. Or if you want to find the sales value for the remaining 8 months, it will be 200 Ghana cedis per unit, and we are producing 3,000 units every month. So that will be 200 times 3,000. That is for 1 month. But we have 8 months, then we multiply by 8 months. So in other words, you can just multiply that by the cost, multiply by the percentage, and get a value. What are we getting? I'm getting 408,000.
Yes, please.
Yes.
Okay. So if it should be you, which of these options will you go for? Will you terminate, or you provide additional, you provide the goods for the remaining months?
Provide the goods for the remaining months.
Yes. So the total cost that we are going to incur over the 8 months is 360. And the termination cost is 408,000. No, I will go for this one. So the company has to make a provision to cover the 360. So make a provision for 360. This provision will be charged to administrative expenses. So we bring a provision of 360. Okay. Then this amount will be incurred over 8 months. So this will be current liabilities. So we go to trade and other payables, then you add 360 because that provision will be exhausted over 8 months. It's not up to 1 year, so it cannot be a non-current liability. Okay, that is a current liability. They haven't taken into consideration that. So you make a provision, you debit liability, you credit liability and debit what profit or loss. That is all about that particular side. All right.
Hey, I'm sorry, Pano.
Let's look at the E, which is the final one.
Okay. So the E, a total dividend of 4.2 million including preference share dividend, was paid in the year and has been charged against retained earnings. Tax expense represents current tax for the year. The current tax for the year, after taking into consideration the above adjustments for has been re-estimated as 8.1 million. Ignore the effect of any deferred tax.
So the issue now is that our actual tax liability now is 8.1, isn't it?
Yes.
But what was the tax liability in the statement of financial position?
9,194.
So 19. So you can now come and subtract. You have to get 8,100. Okay. So since you want more ticks, put it in bracket and subtract to get the 8,100. So how much do we have to subtract from this before we get the 8,100? That will be 1094. Am I correct? We have 9194. But the actual tax liability now is 8,100. So how much do we have to subtract from the 9194 to get the 8,100?
1,094.
Okay. Let's come to the tax expense. Our tax expense is now 8,100 in the statement of profit or loss. Okay. What are they saying about the dividends? They say a total dividend of 4.2 million, including what?
Preference dividend.
Okay. So what is the preference dividend that they are talking about? What is the preference dividend that they are talking about? How much is the preference dividend?
Yeah.
How much interest are we paying on the preference shares? It's 11%, isn't it?
11%.
11%.
Okay.
Yeah.
So the 11% is the dividend that we are talking about. The coupon is the dividends. In the preference shares, we are paying them interest of 11%, which is in the form of dividends. So if you calculate 11% on the preference shares, it is 1430. Are we correct with that? It is 11% on the 13,000. That
Yes,
is
1430.
okay.
Yes, please.
But the total dividend paid is what?
It's
4.2.
4.2 million.
So it means that there is what? Ordinary dividend included in this particular figure. Am I correct?
Yeah. Yes, sir.
So let's determine the ordinary dividends. Let's determine the ordinary dividends. The ordinary dividends will be 4,200 minus 1430. How much are we getting? I'm getting
277.
okay. 2770. Okay. Let's add the figures. Okay, let's total our administrative expenses. How much are we getting for administrative expenses? 73549 minus 160 plus 120 minus 104 plus 360. I'm getting 73765.
Yes, sir.
Okay. Has something affected our cost of sales? No. So it means that the cost of sales will still be the same cost of sales. So let's bring the cost of sales there. That will be 110,323. So our gross profit will still be the one that we have there. So we have 134 134,840. What is our administrative expenses? We have gotten that now, and that is 73765. Our distribution cost, nothing has affected it, so that will be 24516. So what will be our profit before tax? 245. I'm getting 35011.
Yes, please.
Okay. So what is our tax expense? We have gotten the tax expense, which is, so profit after tax is what? So we have
26911.
26911. This is our profit after tax. We don't have any other comprehensive income item. So this profit after tax will be sent to retained earnings, isn't it?
Retained earnings, yes.
Okay. Let's count to the retained earnings. You can see that the retained earnings given to you over there is the closing retained earnings. The retained earnings given to you over there is the closing retained earnings. Okay. So the retained earnings given to you over there, the retained earnings of the 36,109 was gotten as a result of the opening retained earnings plus the profit for the year, which is 27,581. Then they subtracted what dividend from it. Is that how they got the retained earnings over there? They added the profit for the year based on the draft financial statement. The profit over there is 27,581. So they have added that profit to what? To the retained earnings at the beginning, opening retained earnings. Then they subtracted a dividend of what? 4.2 from it, and they have gotten that figure. Do we agree?
Yes.
Okay. Let's now determine the new retained earnings now. Okay, I will show you how you can determine the new retained earnings. Okay. What is the new profit that we have gotten?
26911.
Okay. So we have the profit of 26911. Okay. What was the profit added to the retained earnings?
27581.
Okay. So what is the difference? They should have added 26911, but they have added 27581. Okay. So I will show you the retained earnings. The
670.
Okay. So it means that they have added 670 in excess, isn't it?
Yes.
Okay. So I will show you how we can determine the retained earnings in two ways. So we bring the one in the statement of financial position there, which is 36,109. Okay. They have added what? 760 in excess. Is that correct?
Yes, please.
So we subtract the excess profit added. Okay. The excess profit added. You can show how you have gotten the excess profit there. 760. The dividend subtracted from this amount was what? The 4.2, isn't it?
Yes.
But the dividend that should have been subtracted is the dividend relating to the ordinary shareholders. So it means that they have subtracted the preference shares what? Coupon, which should not be subtracted. So we come and add the preference shares dividend. Preference dividend. We add it back. It should not be subtracted. So that will be 1430. What are we going to get? Add it. Then I will show you another way of getting the retained earnings.
How do we get a 760?
The 760 is the difference between the new profits and the old profits. So we have 27,581. That was the profit added to the retained earnings. But the actual profit after adjusting the statement is 26911. So it means that the profit that should have been added to the retained earnings is this one, but they have added 27581. Then you look for the difference. If there is any understatement, you go and add. If there is overstatement, you subtract. They have added 27581 instead of 26911. So they have added in excess. Go and remove it. Okay. What are we getting?
36779.
277 what?
9.
Okay. I will show you how you can get this figure also. Okay. We all agree that the retained earnings over here was gotten like this. It was we have our opening retained earnings. They have our opening retained earnings. Then they add the profits, which is 27,581. Then they subtract a dividend of 4,200 from it, and they have gotten 36,109. Do you agree with that?
Yes.
Okay.
Yes.
So let's now look for the opening retained earnings. The opening will be 36,109 minus 27,581 plus 4,200. So what will be the opening retained earnings? I'm getting 12728.
127.
Okay.
28.
So this is the opening retained earnings. So we can now prepare our retained earnings now. So the retained earnings will now be calculated as this. So we have our balance drawdown, which is the one that is there, 12728. Then we now add our profit for the year to it. Profit for the year should be 26,911. Do you agree with that? Then we left
Yes.
our dividends. Our dividends of 2770. Are you getting the same figure? To be 36,779. Does it give you the same thing? Are you getting the same figure at the end? Can someone confirm that?
Yes, sir. He
Okay.
said no. Yes, we're getting the same thing. He said no, we're not getting the same thing.
Let me come. Let's
So the
look at
excess
it.
profit should be 670, not 760.
The profit should be 26.
Hello?
Yes.
I said the mistake is with the excess profit. It is 670 instead of the 760 that you.
The excess profit. It
Yeah,
was 6 what?
it's 670.
670. Okay.
But you've written 760.
Okay. So what are you, if we are using that 670, what are you going to get? So if you subtract, what are you getting?
You get 36,869.
36,
869.
869. Okay. If you count to this one, what are you getting?
So which one?
This one, this one. This one, the one that I've shown here, which I started with the opening balance. Are you going to be getting the same figure?
Yeah, you need to get that, yes.
Okay. Okay. So anyhow you want to go about it, we don't have any problem.
Yeah, so this one also be the same.
Yeah. So anyhow you want to go about it, it depends on your understanding of the question. Yes. Someone's hand. Okay. So maybe it's about the figure. Okay. So we can now go and put some of the figures now and close our statements. So the retained earnings is now 36,869. Let's go and put that there. Retained earnings is 869. The settled capital will still be the same because there was no issue of additional shares, and that will still be 52,000. Okay, bank will still be the same because nothing has happened to the bank. So the bank's supposed to be 26 what? Okay, 29198. Am I correct?
Mm-hmm.
Trade receivables is 19807. And inventory was 8736. Okay, let's come to PPE. PPE, the only thing that will happen to the PPE is the impairment review. So 60,424 plus 160. I'm getting 60,584. Can we move on? So let's add that one to our current assets, which will be 577741. What will be the total assets? I'm getting 118,325. So this is our total assets. Okay, let's come to our liabilities, and so 36869 plus 13014. Now let's come to our trade and other payables. What are we getting? So our equity component will be 101,883. So liability and other payables 7862 plus 120 plus 360. I'm getting
8342.
Okay, let's put all of them together. Plus 8,100 plus 101,883. I'm getting 118,325.
Yeah.
Okay. So this is all about this question. Very simple. And okay. So this is all about this question. Very simple and straightforward. Okay. The simple is relative. Okay. The simple that I'm talking about is relative. So in your books, it might not be simple. All right. Can we move on to question 2?
Question 2. The following trial balance was extracted from the books of Fafraha Limited on 31st March 2018. The following notes may be relevant. So should I read the required?
Yeah, let's go to the requirement first.
Okay. So required in a form suitable for publication to the shareholders of Fafraha Limited, the statement of profit or loss for the year ended at 1st March 2018, statement of financial position as at 1st March 2018.
Okay. So what are they asking us? Statement of profit or loss, isn't it?
Yes, sir.
So you can show your skeletons here. Let me check. Statement of profit or loss and other comprehensive income.
It didn't say that.
Okay. So you can add the other comprehensive income to it. For the year ended 31st March 2008. Okay. So the first item that will come is revenue, isn't it?
Yes, sir.
So you have a revenue there. You have your cost of sales. You have your gross profit. Okay. Then you look at the what? You look at the trial balance. We have administrative expenses there. Okay. So we bring administration expenses. Do you have selling and distribution?
No.
We don't have selling and distribution.
No.
Okay. So do you have anything concerning finance costs? We don't have. We don't have anything concerning finance costs. Administrative expenses. Hey, no finance cost. So the only thing is administrative expenses. Okay. So let's bring our, let's see whether we have other income there. So let's add other income. So we have profits. Profit before tax. Then we have our tax expense. Then we have profits after tax. Then we have other comprehensive income, because there will be an issue about revaluation there. So if we scan that well, we have revaluation issues there. So revaluation surplus or loss. Okay. Then we come to statement of financial position. So for limited statement of financial position as at 31 March 2008. Okay, so we start with the non-current assets. So this one, you look at the trial balance. So you can see that we have PPE there, isn't it?
Yes, sir.
So we put a PPE there. We are going to do workings for it. We have intangibles there. So you put the intangibles to there. Okay. So looking at this one, we don't have any other thing again. Then you count your current assets. The current asset. Do you have inventory there?
Yes.
Okay. Do you have trade receivables in the question?
Mm.
We don't have receivables.
No.
Okay. No receivables. Okay. Let me confirm the original question. So move on to equity and liabilities. So do you have stated capital there? The stated
Yeah.
capital is the same as the equity shares. Okay. This one, mostly there will not be any additional issue of shares. So you can decide to bring the 110, but you can read the question. If there is no issue there, then we move on. Retained earnings. So there might be issue of revaluation. So we bring revaluation surplus. Okay. What again? We count to liabilities. So liabilities. Do you have any non-current liabilities there? Do you have any
Sir,
non-current
no, there's
liabilities
no
there?
payables.
Okay, but we are going to have current tax.
Yes, sir.
Okay. So let's take the footnotes one by one. After this, then you now tackle the footnote. Mostly things will not affect revenue. The only thing that will affect the revenue will be maybe IFRS 15. But I don't think, but let's be reading and see.
I. FAFA applies the revaluation model of IAS 16, property, plant, and equipment, to its land and buildings. A revaluation took place on 31st March 2017 and resulted in the fair value of 62 million shown above. This figure included 22 million in respect of land. The buildings were deemed to have a 40-year useful life remaining at that date. No depreciation has yet been charged for the accounting period ended of 31st March 2018. All this depreciation is charged to cost of sales. On 31st March 2018, a further revaluation took place, which revealed a fair value of 24 million for the land and 41 million for the buildings. This is to be recorded in the books in accordance with accounting policy of FAFA.
Okay. So they are saying that the 62 million over there is relating to a revaluation that was done on 31st March
Yes.
2017, isn't it? And this has resulted in a fair value of 62 million. So if you can see the trial balance, you see land and building is 62 million, isn't it? Okay.
Yes, sir.
This figure included what? 22 million in respect of land. So what would be the figure relating to building? So land is 22 million. Land will be
40 million.
22 million. And building will be what?
40 million.
40 million. Okay. The building has what? A remaining useful life of what?
40 years.
Okay. And that was on first what? That was 31st March 2017, isn't it?
Yes.
All depreciation is charged to cost of sales. On 31st March, a further revaluation took place, which revealed a fair value of 24 million for the land and 41 million for the building. This is to be recorded in the books in accordance with the accounting policy of what? FAFA. Okay. No depreciation has yet been charged for the accounting period ended on 31st March 2018. So no depreciation has been charged, isn't it?
Yes, sir.
So the revaluation is not taking place at the reporting period, which is 31st March 2008. The question now is, what are the revalued amounts? The revalued amount for land is what? 24 million.
24 million.
Okay, building is what?
Building is 41 million.
41 million. Okay. The question is, what is the carrying value of these two assets as at 31st March 2008? The land will still be 22 million because the assumption is that we are not depreciating the land, isn't it?
Yeah.
Okay. What will be the carrying value for the building? Land will still be the 22 million, but the building will be what?
Depreciated.
Will be depreciated. That will be 40 over 40 years. Okay, let me show it like this. Okay, the carrying value of the building. Let me show this nicely. Okay, so let's come to the carrying value. So the carrying value will be, the land will still be the 22 million. So land will be 22 million. Building will be the cost less accumulated depreciation. So that will be 40 million minus 40 over 40 because this was done a year after. Okay, so the building carrying value will now be 39 million. Are we okay?
That's nice. Yes, sir.
Okay. Let's come to the revaluation surplus for each of them. Land will be what? What will be the revaluation surplus for land? It will be 24 million minus 22 million. That will give us 2 million. Are we correct?
Yes, sir.
Building will be 41 million minus 39 million. That will also give us 2 million. Are we correct?
Yes, sir.
Okay. What will be the value of the land? What will be the value of land and building? At the value of land and building at reporting,
65 million.
that will now be the 65 million. So
Yes,
land
sir.
and building will now be the new revalued amount, which is 24 plus 41. This is the figure that we are going to show in the statement of financial position. So straightforward, you can go to your statement of comprehensive income and you show a revaluation surplus of, what? 4 million. That will be 2 plus 2. There will not be any deferred tax implication of this because we are not giving a tax rate. Okay, so this one will be we are keeping 3 zeros, so that will be 4,000. Okay, we are done with the first part. We are done with the first part.
And PP will be 65.
Okay, the PP, we are going to put the plants and those ones also. So we do all of them together. So we do this one. Okay, let me determine the cost of sales. Let me do workings for cost of sales too. So cost of sales. Okay. As per the trial balance, what is the cost of sales figure?
So there's no cost also, but there's opening stock.
Okay, so let's start with the opening stock. So it means that we have to determine our cost of sales by ourselves. So opening stock is what?
37,300.
37,300. Okay. Purchases is what?
221,000.
221,000. The question says that depreciation should be charged to what? Cost of sales. So the depreciation is 1 million, which is 1,000. Okay, let's be moving on. Let's come to plant and equipment is depreciated at what? 25% per
Plant.
annum.
Yeah.
Okay. Let's take that one.
Plant and equipment is being depreciated at 25% per annum straight line from the date of purchase to the date of sale. On 1st October 2017, a piece of plant was purchased at a cost of 12 million. This replaced another piece of plant which had cost 8 million some years ago and was fully depreciated period to 31st March 2017. A trade-in allowance of 1 million was received for the old plant. The only entries made to record these transactions were to credit cash and debit suspense accounts with a net payment of 11 million. No other item of plant was more than 3 years old at 1st April 2017.
Do you even know what they're talking about? Yeah, do you even understand what they're talking about?
Did they dispose of that?
So they are saying that plant and equipment is depreciated at 25% per annum, straight line from the date of purchase to the date of sale, isn't it?
Yes.
On 1st October 2017, on 1st October, what is the reporting date now?
31st March 2018.
So 1st October 2017 to 31st March, how many months is that?
6 months.
Okay, that will be 6 months. Okay. A piece of plant was purchased at a cost of 12 million. Okay. This replaced another piece of plant which had cost 8 million some years ago and was fully depreciated prior to what 31st March 2017. So they are saying that there is a plant which cost what 8 million, isn't it? And was fully depreciated. It means that the accumulated depreciation is the same as the cost. We are not using it again. We have used it for the number of years that we want to use it. Okay. But go to the trial balance. Plant and equipment, plant and machinery is carried at what?
60 million.
No, it's carried at cost, isn't it?
Yeah, of course.
What does it mean? It means that the plant that has been fully depreciated, the cost is still there. They are still carrying it at what? The 8,000, which is 8 million. So the 8 million is part of the 60,000. Count to accumulated depreciation. Accumulated depreciation is what? 20,000, isn't it?
Yes, sir.
What is the meaning? The meaning is that the 8,000 of the machine that was fully depreciated, the full depreciation of 8,000 is still in the 20,000. Although the plant and machinery was fully depreciated, it has been used. There is no residual value. There is no value for it. But since we are carrying plants and machinery at cost, it means that the cost is still there. And the accumulated depreciation, the full amount of the cost, which is the 8 million, because we have used the asset fully. So the cost will still be the same as the accumulated depreciation. So inside the cost of the 60 million, the 8 million of the machine that is fully depreciated is still there. And inside the accumulated depreciation, which is equal to the cost, is also still there. But the asset is not there. We have used it all. It is of no use. So what we do is that we have to remove that 8 million from the 60 million and also the accumulated depreciation of what? 20 million. Okay. So the cost of the remaining assets will now be 52,000, and the accumulated depreciation will now be what? 12,000. We have taken the fully depreciated assets. But that is not the issue. Let's come to the major issue. A trade-in allowance of 1 million was received for the old plant. Although we are saying that the old plant, we have fully used it, we are no longer using it. But the person that we are buying the new plant from is saying that, okay, they can take the old one and they will give us a value of what? 1 million. So that 1 million is representing what? The
Gain
asset.
on disposal.
Okay, that will be a gain on disposal. So you go to other income and have your gain on disposal. Though we are not still using the asset, but we are giving it to someone for what? 1 million. Okay, that will be 1,000. So that will be a gain on disposal, 1,000. Okay. They are saying that the only entries made to record this transaction were to credit cash and debit suspense with the net payment of what? 1 million. So since we are giving the asset to you for 1 million, it means that we are going to give you a cash of what? 11 million. The asset that we are buying from you is 12 million. You are saying that you are going to take our old assets, which we are not using, at 1 million. It means that we have to top up by 11 million. So if you are doing that, what you have to do is that you are going to debit cash of 11 million. But what will now be the issue? You have to debit, you are going to credit cash with 11 million, which is the actual cash that you have paid. And you have to debit the asset of what? 11 million. But the question is, this asset is not 11 million. It is what? 12 million. But we are making a gain of what? 1 million. So we are going to add 12 million to our plant to remove the what? The suspense account. We have to remove the suspense account. That particular suspense over there should have been added to what? Plant and equipment. The debit entry should have gone to plant and equipment. So we are going to have the old plants that will be removed because we have sent it to the person. So the cost will be removed from the plant and equipment, which is the 8 million. Accumulated depreciation too, we are going to remove the 8 million because we have fully depreciated the asset. We have fully depreciated the asset. But since we are carrying the asset at cost, although we have fully depreciated the asset, the cost of 8 million will still be in the cost, as if the asset is still there. And accumulated depreciation, we will still have the 8 million. So this is how we are going to show for the plant and equipment. This is how we are going to do the workings for the plant and equipment. Okay, let's come to plant and equipment. So the remaining amounts, the remaining plants and equipment, will be the 60,000 minus 8,000, which is a plant that was fully depreciated. So we now have 52,000. Okay. So this will now be the plant, which is the 52,000. This will be there for full year because these are the old plants that will be there for full year. So let's calculate depreciation on that. So the depreciation will be 25%. So 0.25 times 52,000. What are we getting?
$13,000.
13,000. Okay. This depreciation is for the old plant. Let's count to the new plant. The new
Sir,
plant.
please, I want to ask something. No.
Okay.
You see, at the end of the statement, they said no other item of plant was more than 3 years old at 1st April 2027. Will it affect the depreciation anyway?
No, please.
Uh,
What they are telling you is that the remaining plant and equipment are old ones. So they have to attract what? A full year depreciation. But the new one that you bought now is 6 months. You can see that it's still no more than what? More than 4 years because you have used 6 months already because you bought it on 1st October. So at the reporting, the remaining useful life will be 3.5 years. So that's what they are saying. All right. Okay. So let's come to the new plants. The new one that will now be the depreciation will now be what? Depreciation will be 12,000, which is the cost of the assets, times 0.25 times 6/12. Do you agree on that?
yes.
Okay. So what will be the depreciation for that?
1,500.
Okay. So 1,500. Okay. So our total, let's come to our total depreciation. Our total depreciation will now be 1,000 plus 14,500. Do you agree with that? The 1,000 is for building,
Yes, sir.
then plant, and this one will be what? 14,500. That will now be 15,500. All right. We are done with that. Let's come to the footnote 2. Let's show the workings for PPE. Let's show our PPE now. Let's show our PPE. Okay. Some people, they will say they want to prepare PPE schedule. No, don't worry yourself. Just show property, plant, and equipment. Okay. So this property, plant, and equipment, I will show you how you can go about it. Okay. You show your balance drawdown. What is the balance drawdown for the PPE? The land and building is 62,000. Plant and equipment is what?
And plant and equipment is
60,000. Okay. So if you add the two, what are you going to get? Those are the opening balances.
so why 60,000? It's supposed to be 52,000.
The
Oh.
52, the 8,000 is still in the depreciation of 20,000. So if we use the 20,000 and that one, it will just cancel like that. Are you okay?
Yes.
The 8,000 is still in the accumulated depreciation. So we are going to use the total of the accumulated depreciation so that the two can just cancel out. So if you are subtracting 8,000, it means that you have to subtract 8,000 from the accumulated depreciation too. All right. So the balance brought down is what? 122,000. Okay, you add the land and building plus the 60,000. Okay, let's come to additions. Were there any additions during the year? Were there any
Yes,
additions?
12 million.
Okay, 12 million. Were there any revaluation surplus?
Yes.
Okay, that was 4,000.
1
isn't
million,
it? Okay.
4,000.
Let's count for accumulated depreciation. Accumulated depreciation will now be 20,000 plus the new depreciation, which is 15,000 what? 500. We have the depreciation at the beginning.
14,500.
No, it's 15,000.
Yeah, 15,500.
Okay. So that will give us 35,000 what? 500. So what will be the closing balance for PPE now?
Then 102,500.
102,000. Okay. So that is your PPE. Go and show that in your statement of financial position. Yeah, Kojo. Kojo, hand it up.
Sir, please, with the depreciation charge, please.
Okay.
Hello.
Yeah, I can hear you.
Yeah, please, with the depreciation, please. Where did you get 1,000?
The 1,000 is for building. The first one that we did,
Okay.
we have we depreciated a building for 1 year.
Yes, sir.
The building was, the value of the building over there is on 31st March 2017. So the building will be used for that time to 31st March 2018, and that will give you a 1 year. So we have used the building for 1 year. So it means that we have to depreciate it. And the value of the building at the beginning of the year is 40 million. And the useful life is what? 40 years. So we have to depreciate it for 1 year. And that will give us the 1,000.
Thank you, sir.
Okay. Okay. So let's now come to the footnote 2.
Footnote 2. The inventories figure in the trial balance is the opening inventory balance measured on first in, first out FIFO basis. Due to a change in Fafa's business, the company decided to change its accounting policy with respect to inventory to a weighted average basis as follows. Closing inventory at 31st March 2018 measured under the weighted average basis amounted to 41.2 million. Sorry.
Okay. So what standard is this?
Inventories. Is 2.
No, please.
It's not inventories.
This is IS 8. Change in accounting policy and those ones. So you can see that they have changed the accounting policy, and this should have a retrospective effect. So this is a change in accounting policy. Okay, they are now changing their inventory valuation method from FIFO to what? To weighted average. So we are assuming that the weighted average has been in existence from the time that we are provided with this particular information. Okay, so the question now is for 31 March 2016, under the FIFO method, what was the closing inventory there?
34,100.
No, 31st March 2016 under the FIFO.
FIFO. 2016 or 2017?
No, 2016 is what? 33,200, isn't it?
Yes,
okay. Sir. But this was a closing balance, right?
Yes.
So it means that if you count to the 2017 year, this will now become an opening balance.
Yes, sir.
Can you see that?
Yes, sir.
Okay. So it means that we have overstated our inventory for 2016. That is a closing inventory. But the subsequent year, this will now be opening balance. So it means that the effect will now be what? Will be neutral. We are overstating our closing stock. Then the following year, we are going to be overstating our opening stock. That will be having the same effect. Or if you like, you can try it. Let's come to 31st March 2017. What is the difference between the FIFO and the weighted average? Figure there. What is the difference between them? 31st March. I'm getting 2,900.
Yeah, 3,200.
Okay, if you find the difference is 2,900. FIFO is 33,200. Weighted average is 30,300. What is the difference?
Yeah, 2,900.
Okay, so it means that for 2016 year, the closing stock, if we should be using weighted average, it should have been 30,300, but they have used 33,200. They have overstated their closing stock by 2,900. Okay.
Yes, sir.
But this 33,200 will become opening stock. Will become opening stock for what? For 2017, isn't it? Okay.
Yes, sir.
So it means that the opening stock has also been what? Overstated by 2,900.
Yes.
So you can see that the effect is going to be zero. Closing stock was overstated. Opening stock is now overstated by the same figure. There will be a zero effect on that. So we don't do anything to that particular one. But let's come to 2017. 2017. What was the closing balance used? What was the amount used for the closing inventory?
For
What was the
FIFO.
amount? It was a FIFO, which is 37 what?
300.
Okay, that is 37,300. But what should have been the actual figure? It should have been 34. It should have been 34,100, isn't it? Okay, what is the difference?
3,200.
Okay. Okay. You can see that the closing stock was overstated by how much? The closing stock used for 2017 was 37,300. But if we are using weighted average, it should have been 34,100. So we have overstated our closing stock by what? 3,200.
Yes.
If closing stock is overstated, what is the effect on profit? What will be the effect on profit? If closing stock is overstated, what is the effect on profit?
Overstated.
Profit will be overstated. It means that the profit for 2017 is overstated by 3,200. Are we okay? All right. But if you come to the new year, since we are changing the closing stock for 2017, it means that 3,400 or 3,100 should be the opening stock for 2018. So we are changing from FIFO now to what? To weighted average. So the closing stock will be stated now at the weighted average figure, which is 3,400. It means that the opening stock, because this closing stock will become opening stock for this year. Since we are using this one, it means that our opening stock should also be 34,100. So let's come here to the cost of sales. We are now coming to reduce our opening stock. So reduction in the opening stock. We reduce it by 3,200. Okay. Since we are reducing this by 3,200, it means that the closing stock, this was closing stock for 2017. So since we are reducing it to 34,100, because this is a change in accounting policy, we should apply it as if the policy has been in existence since. So we try to reduce all the figures. What should have been the correct one if we are using this policy? So we go to the previous years and adjust everything as if we are using the weighted average policy since. So it means that this year, look at the opening stock in the trial balance. What is the opening stock figure there?
37,300.
So it means that they are still carrying the inventory at FIFO method, isn't it? So we have to reduce it to what? To the LIFO method, to the weighted average method, and that will be 34,100, but we are using 37,300, so you have to reduce it to 34,100. This figure was closing stock for the previous year. So since we are reducing it to 34,100, it means that we should assume that we have reduced it for what? The last year too. We have reduced the closing figure for last year too. So we are going to retain earnings and take 3,200 from it, which was the what? Overstatement of our closing inventory for the last year. Okay, so you reduce this one like this. What is the closing inventory? What is the closing inventory under the weighted average method?
So you said
What is the closing inventory under the weighted average method?
4.1, 41.
So
Point
weighted
two
average, we will now be using weighted average method. So the closing inventory will now be 41,200. So if you go to your statement of financial position, you show your inventory at 41,200. That will now be the new value of your inventory. Okay. Let's come to the II.
I. Intangible assets consist of capitalized development cost of 30 million. These relate to products in development at 1st April 2017. No revenue has yet been earned from any of these products. They are all expected to be successful once ready for market, with the expectation of one project. The amount previously capitalized in respect of this project was 6 million. However, adverse developments have led to the decision to abandon the project as it was unlikely to be successful in the marketplace. During the year, further expenditure was incurred on other qualifying projects and was charged to administration expenses. The amounts are as follows: prototype development costs 3 million, marketing research to determine the optimal selling strategy 1 million, basic research which may lead to future projects 4 million.
Okay.
Something.
Okay, let's come here. So they are saying that the intangibles, how much is the intangibles in the trial balance?
30 million.
Okay, and they say this relate to what? This relate to
Development
the
capitalization.
product in development. The product is still in development, isn't it?
Mm.
Okay. No revenue has yet been earned, so we don't amortize the cost because the product is still in development. It's not ready for sale. Okay. No revenue has yet been earned from any of these products. They are all expected to be successful once ready for market. Okay. With the exception of one project, the amount previously capitalized in respect of this project was 6 million. However, adverse development has led to the decision to abandon the project as it was unlikely to be successful in the marketplace. So they are saying that the 30 million, there is a 6 million in it. But this product right now, we decide not to undertake it again. So what is happening? What do we say? What is the issue relating to that particular product? Will a 6 million still be part of the 30 million? Would a 6 million be part of the 30 million?
No.
Why? Okay, it will not be part because the project has impairment of the what? The project. The project will no longer be successful again. So that will be treated as an expense. That will be treated as a cost. So this will be included in administrative expenses. So let's show the administrative expenses. So admin expenses. Let's show the workings for that. Okay. What's the figure shown for admin expenses? In the trial balance, what is the figure for admin expenses?
120 million.
Okay, 120,000. So we now come to impairment of the project. and that will be a cost. So impairment of that project will be 6,000. Okay, projects or project development, that will be 6,000. Okay, let's come. So that should be removed from the 30 million because the project will not be successful again. So that should not be part of the project. We should ignore it. So the cost over there will be expensed. Okay. During the year, further expenditure was incurred on other qualifying, other qualifying assets and was charged to administrative expenses. The amounts are as follows. Prototype development cost. Do you know what we call prototype? Prototype. Prototype is just like a sample, the product that we are developing. Yes, the product sample. So we develop the product sample and give it to the customers. So since we are developing a product sample, it means that the product is going to be successful. So product design, prototype, and any other cost relating to the product or to the project to be capitalized. So prototype development costs are supposed to be what? Capitalized, not expensed. Because since you are going further to develop a sample of the product, it means that you are convinced that the product will be what? Successful. So prototype cost should be what? Should be capitalized. But let's come to marketing research costs. Marketing research to determine the optimal selling strategy. Should this cost be capitalized?
No, sir.
Okay. This is a market research, and this is to determine the selling price. To determine the right selling price. No, you can start selling a product if you don't even carry out a research to determine the selling price. The selling price has nothing to bring the product to a state that it will be ready for sale. So that particular market research to be what? Should be expense, and that has already been expense. So what we do is that the prototype cost has been expensed to administrative cost. So we come and remove it. So the prototype, all of this cost has been charged to administrative expenses. So since we are capitalizing the prototype cost, it means that it should be added to intangibles. So we come and remove it from the administrative expenses. Okay, the marketing research cost should be expensed, and they have already expensed it. Okay, basic research which may lead to future projects. So this research, we are doing it for future projects. Even without the product, we are still going to carry out a research, this particular research. So research cost should be what? Expense, and they have expensed this. So that is fine. So let's come to our intangibles. Let's show workings for the intangibles now. The intangibles will now be this. As per the trial balance, okay, that will be 30 million. But there was what? Abandoned what? Projects. So that is an impairment. Abandoned project of 6 million. That should be expense. It's no longer what? Needed. They are saying that it will not be successful. So it should not be part of our product again. We take it off. Then we come to the prototype. The prototype cost should be capitalized. So we add 3,000 to it. So our intangibles will now be 27,000. So you go to your statement of financial position and show intangibles of 27,000. Okay. We are done with that. That is very simple about that particular issue. The 6 million should be removed from intangibles and expensed. The prototype cost should be capitalized, but all these costs were expensed. So you have to go and remove it from administrative expenses. Ivan, let's look at that. Auntie Gina, can you take that one for us?
Oh, sorry, I was even reading. Ivan, Fafraha commenced construction of a new warehouse on 1st May 2017. The building was completed and available for use on 30th November 2017. The cost of construction amounted to 9 million, funded out of general borrowings, which comprise two bank loan as follows: 4 million of Ghana cedis of bank loan financed at 6% interest. 6 million Ghana cedis of bank loan financed at 4.5% interest. All interest costs have been expensed in the year 31st March 2018, but no other entries has been passed in respect of this. Ignore any depreciation in relation to the new warehouse.
Okay, the first standard that we look at, what's the first the footnote 3, what standard is that?
IAS 38.
Okay, and the footnote 4 is what?
IAS 23.
Okay, that is borrowing cost. Okay, Auntie Gina, you don't know that because I didn't teach you. All right, this is borrowing cost. And which type of borrowing cost is this? Which type of borrowing is this? Is it specific or general?
General borrowing.
Okay, so this is a general borrowing. Okay, and you can see that these loans were used to what? Were used on the construction of an asset. So the interest that we are going to pay to cover the period that the asset was under construction, that particular interest should be added to the cost of the asset. When did the company commence the construction of the warehouse?
1st May.
And this was completed on which date?
31st.
30th November.
Yeah.
Okay, how many months is that?
7 months.
Are you sure?
June, July, November.
May, June, July, August, September, October. I'm sure it should be 7 months.
Yeah,
May,
7 months.
May, June, July, August, September, October, November. If you're not sure, you can count your hands. Nobody's going to punish you. So
7 months.
the interest for 7 months should be added to the cost of what? The building. But how do we determine the interest? How do we determine the interest? Let's take the loans one by one. Let's take the loans one by one. So the first loan, what will be the interest that we are paying on the first loan?
6%.
6% on what? 4 million. So 0.06 times what? 4,000. Okay, that will give us how much?
240.
240. The second loan, what will be the interest? That will be 0.045 times 6,000. Are we correct?
Yes.
Okay.
270.
270, isn't it? Okay, what is the total interest?
$510.
510. Okay. So this total interest was paid on what? Total amount of 10,000. Do we agree with that?
Yes.
So the total interest that we paid on a total loan of 10,000 is 570, isn't it?
Yeah.
Okay. The question is what percentage rate, if we apply it on 10,000, it will give us 570. What percentage rate? That is the question. The percentage rate will be calculated like this. It will be calculated as the rate will be calculated as the interest over the amount times 100. You can try it. This is what you're going to get. So what is the interest? The interest is 510, isn't it? And total
Yes, sir.
amount is what? 10,000. All this one multiplied by 100. What will be the interest?
5.1%.
5.1%. This 5.1% is what we call the weighted average cost of capital, or the WACC. So this is a general borrowing where you are going to be taking money from a lot of what? Pool of funds. You have a lot of what? Finances, and you are going to take the money from them small. So you take small amount of money from this place, small amount of money from this place, and they are all coming with a different interest rate. So the question now is, we need to find one interest rate which we can use to what calculate the borrowing cost relating to the amount that we use on the what on the construction. So if it is general borrowing, we calculate what we call WACC, and the WACC is calculated like this. The WACC is calculated like this: the interest or the total interest on all the funds that are used over the amounts. The amount is the total amount of the funds that were used. So we have the interest. The interest was 510, which is the interest on the two loans. That would be 510. The total amount of the two loans is 10,000. So the interest over the amount times 100, and that is a 5.1. So the WACC, the interest rate, is now what? 5.1. But the question is, how much was used on the what? On the warehouse? How much was used on the warehouse?
9 million.
9 million. So if we want to pay interest on the 9 million, what will be the interest? So the interest will be 0.051 times 9,000 times 7/12, because this was used for only what? 7 months. So what will be the interest? What will be the borrowing cost? 0.051 times 9,000 times
267.
7/12. 268. Let's make it 268. So the borrowing cost will be 268. So the cost of the warehouse, let's determine the cost of the warehouse. The cost of the warehouse is determined like this: the amount, which is the cost, the amount spent, which is the initial cost, which is the 9 million. So we have constructed the warehouse for 9 million, but then again, we are going to capitalize the borrowing cost of 268. So this one will now be 9268. This is the value of the warehouse. And the question says that no entry has been made in relating to this, apart from what? Expressing all the interest. So the interest of 510, 26 out of it will be what? Will be capitalized, and the remaining one will be expensed. But since we don't have a finance cost in the question, the assumption is that the interest is in administrative expenses. So we come here and do subtract the borrowing cost of 268. So it means that they have charged all the 510 to the administrative expenses. Add 26 out of that should be added to the cost of the warehouse, because the loan, part of the loan, we are used in the construction of what? The warehouse, and the warehouse is a qualifying asset. So the interest relating to that portion should be capitalized, and that is 268. So 510, 268 of it should be added to the cost of what? The warehouse. The cost of the warehouse. Okay.
Sir, please go back to the cost of the warehouse.
Okay. So they are saying that the cost of the construction amounted to what? 9 million, funded out of what? General borrowing, which comprised two bank loans as follows. So what is the cost? What is the total amount that we have incurred on the warehouse? What is the amount that we have? It is 9 million, isn't it? Okay. The question says that all interest cost has been expensed in the year to 31st March 2018, but no other entries has been passed in respect of this. So it means that we haven't recognized the warehouse also. Are we correct with that? The warehouse has not been recognized. So if you are coming to recognize the warehouse, what will be the double entry? You debit assets, which is the warehouse, and what will happen?
Yeah.
What will be the corresponding entry? You are going to pay for this particular what? you are going to pay the constructors. So the 9 million, you are going to pay it out of cash. So you
Yeah.
bring the warehouse and you credit cash because we are going to pay the 9,000 out of what? Out of cash. You are going to pay the people. Okay. So you bring the warehouse. You bring the warehouse. Okay. Since we can decide to add it to the PPE, we can decide to add it to the PPE. So the PPE will now be 10 to 500 plus 9268. Then we come to cash and cash equivalent. That will be cash and cash equivalent is 7,500, 75,700 minus 9,000. Okay. Are we okay with that? Let's move on to the next one, the last one, then we close.
Corporate tax for the year
The
is
question says
estimated at
that the question says that ignore any depreciation relating to the new warehouse. So if the question didn't say anything like that, they would have given us the useful life of the warehouse. So the warehouse was available for use on 30th November 2018. So from November or from December to 31st March, how many months is that? That would be 4 months. So if we should have been given the useful life of the warehouse, we should have depreciated for what? 4 months, because the asset was ready for use on 1st December. And we have used it from 1st December to 31st March for this year. So we have to depreciate it for 4 months. But the question says ignore any depreciation in relation to the new warehouse. So let's go to the final one. Let's go to the final one. Then we put our figures together. So
corporate
7,500.
tax for the year.
Okay, corporate tax for the year is what?
0.25 million.
Okay. So the corporate tax, what are they talking about? That is the tax expense, isn't it?
Yes, sir.
Okay, that will be treated as a liability, which is 2,500. Would that be 2,500 or 250? We are keeping 3 zeros, so that will be 250.
250,000.
Okay, that will be 250. So tax expense will be 250. Okay. Let's come to our revenue. Let's come to revenue. What is the revenue figure? 372,000.
300.
And nothing has affected that. Let's come to cost of sales. The cost of sales, we have to do workings for it. And what is the workings for the cost of sales? Okay, let's pick the cost of sales figure now. We have our 37,300 plus 221,000 plus 15,500 minus 3,200 minus 41. $41,200. I'm getting 229,400. Is that correct?
So you're getting what?
229,400.
400. Yes, sir.
So 229,400. Okay, let's subtract. What will be our gross profit? I'm getting 142,600. Okay, so this will be maybe workings 2. So let's come to administrative expenses, workings 4. So let's go and put our administrative expenses together. So our admin expenses will be, let's put admin expenses together now. That will be 120,000 plus 6,000 minus 3,268. I'm getting 122,732. Confirm. Is that correct? 122,752.
Yes, sir. Correct. Okay.
Okay. Okay, so our admin expenses will now be, this will be subtraction, 122,732. Okay, so what will be our profit before tax? I'm getting
198.
I'm getting 20,868. Confirm. Do it again. I'm getting 20,868. Is that correct?
Yes.
Okay. Then we come to the tax expense. Tax expense is 250, so minus 250. So we are going to have a profit for the year of 20,618. Okay. Then you add the other comprehensive income, 4,000. That will be 24,618. And that will be the total comprehensive income for the year.
I said, why is the tax 250?
It says the corporate tax is 250. The last one is 0.25. So you multiply by 1,000. Do you get it? The last
Yes,
footnote, corporate tax for the year is estimated as 0.25. So we are keeping 3 zeros.
Yes, sir.
Okay. So let's
Thank
now
you.
count to. So the profit for the year will be sent to what? Retained earnings. So let's now do our retained earnings. There is no dividend paid for the year. There is no dividend there. So let's show our retained earnings. So maybe working 6, we have our retained earnings. So our retained earnings, we have balance brought down. What is the retained earnings figure in the question? That is 115,000. Then we have profits for the year. Okay. The profit for the year, the only one that we are going to show is the profit from the profit, this one, 2618. This will go to revaluation surplus. Okay. So 2618. 2618. So 2618. And let's add 115,000, 115,000 plus 2618. That will give us 135,618. So you go to statement of financial position and you bring your retained earnings of 135,618. The revaluation surplus will be 4,000. Our equity shares is 110,000. Our equity shares is 110,000. So let's add this. We are going to have a plus 110,000 plus 4,000 plus 250. I'm having 249,618 plus 250. I'm having 249,868. So that is the total equity and liabilities. Let's count to our PPE. 210, 2,500 plus 9,268. I'm having 1,11768. So if you add 27,000 to 27,000, I'm getting 138,768. So plus 41,200. Sorry, the retained earnings. Sorry, the retained earnings, we need to adjust this one. The retained earnings will be this. The retained earnings. Okay. You can see that the adjustment that we have done for the inventory. So retained earnings will be 20,618. But the overstatement of Overstatement of
3,200.
closing inventory should be subtracted from the opening retained earnings. That will be 3,200. Okay. So let's still do that. So I'm having 115 plus 2618 minus 3,000. I hope you are okay with the 3,200. Okay. So that means the profit for
Yeah.
last year was overstated, and last year's profit is in the opening retained earnings. So we go and adjust it. So the retained earnings will be 135,618 minus 3,200. So that will be 132,418. 418. One, three, two, 418. Let me add plus 10,000 plus 4,000. I'm getting 246. So 4,000. I'm getting 246. 246. 418.
Yes.
Okay. So plus 250. I'm getting 2. So 246,668. Okay. So let's put the asset together. 138,768 plus 41,200 plus 66,700. Two, 4, 6, 6, 6, 8.
So please let me look at ahead. Can I look at your assets?
Is that assets?
Sir, please, can I see the working for the cost of sales?